Are you a business owner looking for more ways to save taxes and to accumulate more assets? Hey, this is Thomas. In this video, I'm going to share with you why business owners in Canada love to leverage life insurance under their corporation. As usual, let's identify what seems to be the problem first. If you're self-employed or you have a profitable business, your accountant will usually recommend you to get incorporated. Why? Because of taxes. Imagine if you make $500 in personal income, then easily you have to give half of that money to CRA as taxes. But if you have a Canadian-controlled private corporation, or CCPC for short, then under the Small Business Act, any active business income that's lower than $500,000 will only be taxed at 10 to 14% depending on which province that you're in. So right from the get-go, that's $50,000 compared to a $250,000 tax bill, a big difference there. And second, as you're the owner of the business, you get to control how much money going back to you personally, so you also can control when to pay that tax bill. And that sounds great, but what's the catch? Well, as I mentioned many times, CRA is always the smartest person in the room. So say, sure, any active business income, I'll give you a carrot, but any passive income that you make in the corporation will be taxed at 47% to 54%. Again, depends which province that you're in. And let's just round it to 50%, and this 50% is not by tier like in the personal tax bracket side. So literally, every dollar you make on your corporate investment, then you have to pay 50% to the CRA. And not only that, started in 2019, if you make more than $50,000 in passive income, then your $500,000 small business deduction room will decreases. And say you have the multiple properties in the corporation and collect more than $150,000 rental profit, then you lose all the $500,000 room, meaning all income has to pay 27% to 30% instead of 11%. The reason why CRA is giving a hard time on that is because too many business owners are shuffling their assets under the corp and try to pay less taxes. And remember, unlike the personal side, there's no such thing as the corporate-owned tax-free savings account. So how can we save more taxes? And that's how life insurance comes in. Before I keep going, I would like to show you some data. This is a report done by one insurance company back in 2022. For example, there were at least 1,700 new life insurance cases which the client is putting down between $10,000 to $25,000 per year. If we look further up, there were at least 400 new policies in 2022, which the client is willing to contribute $100,000 to $250,000 annually to their life insurance policy. And lastly, there are at least 40 cases that client was willing to put $1 million and above every single year. And that's just one report from one life insurance company only. With that money invested, don't you think the client will consult their accountant, tax lawyer, or CFO first before making that decision? Or don't they have other investment choices such as real estate or stock market? Is there something that they know and you don't? Well, let's find out. Based on a statistic, if you ask 100 people what your life insurance policy do, 84% of them will answer it's a product that pays to your family if you pass away, which is true. However, let's dive in deeper why the wealthy people like to invest in life insurance. There are two kinds of corporate-owned life insurance. That's the term life insurance and that's the permanent life one, just like the personal side. Usually, business owners like to buy term insurance for their key employees because if something happens to them, the company needs the money to replace that key person. The cost will be similar to the personal one and not too much surprise on that. In the world of business, it's crucial to prepare for uncertainties and financial challenges, but that's not the main reasons why business owners are willing to put six figures into the insurance plan. What I want to focus is on the permanent life insurance side. First, let's clarify what permanent life insurance is. Unlike the term life insurance, which covers you for a specific period, permanent life insurance, as the name suggests, is for life, and for most of the plans out there, it includes both death benefit and a cash value component that grows over time, which you can access it during a life. And here's the fun part, and under the Insurance Act, those savings, or people call them cash value, are tax sheltered as long as the death benefit is reasonable. So problem number 1 is solved, that you created an account where you can grow your saving tax shelter, so it will not trigger the passive income tax. So why would an entrepreneur wants to invest in life insurance instead of, say, a stock portfolio or real estate? Couple reasons for that. First one is back to the tax issue again. Sure, there's no capital gain tax immediately if you buy and hold your stock portfolio or real estate. However, if you have dividend payout or rental income, then it's subjected to the 50% tax rate. But Thomas, don't I have to pay tax too if I withdraw money from the life insurance? And you're right, it could subject to tax as well, and therefore in many scenarios, the experts will recommend you to borrow against it instead of taking it out. Similar to real estate and home equity line of credit, insurance policy can also provide an insurance line of credit based on the cash value you have in the policy, and the banks are happy to approve it because they know their money is secure even if you pass away. And because now it's a loan, it's not a profit, so it will not trigger the passive income tax. Borrowing against your cash value offers you the flexibility to reinvest that money in other projects, such as back to the real estate market or invest back into the business, and the interest now become an expense, and which further decreases your tax bill. And what's more, your policy continues to increase in value even as you borrow against from it. Consider the analogy of a house again. If you borrow against your house, the house doesn't stop appreciating in value. And for the life insurance policy, borrowing against your cash value doesn't halt its growth. It continues to increase, providing a unique advantage over the other investments like mutual fund or stocks where you cannot ask for a loan. Oh, and one more thing, and this is very crucial when it comes to retirement planning for business owners. Say the business owner is now retired and he or she needs money for their personal usage. Therefore, they need to take out the money from the corporation either through the salary or dividends, with subjects to the personal tax bracket, which is easily 20 to 40%. Now, the best part is if you set it up properly with the corporate-owned life insurance plan as the owner of the company, you can actually borrow directly from the insurance itself, and therefore you can potentially skip the salary dividend tax. Again, it's very complicated and involves a lot of fees, but it can be done and achieved tax-free entirely. So now brings in the key question, what happens to the policy if I'm dead? Again, if it's personal life insurance, then the death benefit is 100% tax-free, minus all the money that you borrow and the guarantees there's still money left for the family. Now, for the corporation, if the insured die, the policy kicks in and pay off all the loan balance and goes into the corporation because the corporation has to be the beneficiary. And here's the magic happening. Majority of the death benefit will go to an account called the capital dividend account. Think of it as a notional account where the shareholder can withdraw it tax-free. So if you have a $10 million death benefit, it will create close to a $10 million of tax-free room for the shareholder to withdraw it tax-free. I try to simplify a lot for the viewers, so again, please talk to the experts that really know how the CDA works. In short, for the money that you invested in the corporate-owned life insurance, not only you get a protection, you also can grow tax shelter while giving you access during your lifetime and provide tax-free money to your family and other shareholders. It kills many birds in one stone, and that's why business owners love this concept. But hey, even though this is a great concept, there are a lot of things need to be carefully examined. For example, a key point to remember that once a permanent life insurance policy is placed within a corporation, it's generally best to keep it there. Attempting to move it, especially after a significant period such as 5, 10, 20 years, can trigger you having to pay additional tax on the money that you earned. So say if you're an operating company like a restaurant, that's not a good idea to have it in there. You rather want to have it in a holding company that owns that operating company and put the life insurance in that holding company. Second, another crucial element of this strategy involves understanding the Canada's lifetime capital gain exemption. This provision can play a significant role in your tax planning as a business owner. Essentially, it allows a business owner to sell or dispose of shares from the eligible corporation and obtain a tax-free capital gain close to $1 million. This exemption can be especially advantageous when selling your corporation or disposing your shares. Third, what kind of permanent life insurance is ideal for you and your corporation? There are mainly two types, which is the universal life and the whole life insurance, and they are very different in terms of the cost of insurance, the return on the cash value, the limitation when it comes to borrowing, and etc. etc. And lastly, of course, are the advisors themselves. How experienced are they? Do they know how to structure it properly? Are they willing to talk to your accountant or CFO for this strategy? Do they have any connections with the banks that are willing to do the lending side? And one last time, the purpose of this video is just to show you why business owners love to leverage life insurance in Canada. So please, talk to your financial planner, talk to your accountant for your own situation. And let me know if you have any questions, and we really need your feedback. My team and I do spend at least minimum of 10 hours to research and to prep the videos for you guys, so your comments and the big thumbs up are the big support to us. Alright, thanks so much for watching. This is Thomas, and I will see you in the next video.